Hello and welcome to Investing Confidential. Well, if you've been listening to me, I haven't been doing many videos, but because it's basically plain. I mean, I spelled it out for you. The market was too bearish, and we finally saw the capitulation. Okay, the bears gave up, and I'll show you reasons why I believe they have. I'll also talk a little bit about why you can't get too bullish here because Jim Cramer's bullish. This morning he's very bullish, so you really can't go bullish. You can't be too bullish. It's probably too early to be short. Probably I'll show you reasons why you should be selling into this rally. And obviously, the most important thing is positioning, and I'm going to go into positioning. I'll just mention Kava. The yesterday this IPO was up almost 100%. Now, normally when you've had this situation where you've had no IPOs for 18 months or very few IPOs over 18 months, the IPOs perform okay, but they don't perform like this. This is usually at the top. This is usually when we see a feeding frenzy. So this is very unusual. It again points to we went from extremely bearish to all of a sudden people are nuts and buying crazy positions in a company like Cavo that is losing tons of money. It makes no sense. It's incredibly overvalued. If I had Cava, I would sell it right here. Okay, end of story. And also, so let's just address this whole bull market thing. Okay, so as you can see here, what history tells us is that when the market retrenches from the lows 20%, you enter a new bull market. I'm not going to argue with history. It happens quite a bit. It doesn't happen all the time, but certainly, this is what has basically capitulated the bears here and got the bulls, going again. So, it's tough to go against this kind of stuff. And again, here's another chart. I mean, this is also pretty interesting. The S&P now is at or above when the Fed started hiking. Now, from a standpoint of normally you'd look at this and say, "Wow, this is impressive," but it's not because it's really seven to 10 stocks that have driven this. The rest of the market's been left behind up until the last couple of days. So you don't really have this retrenchment that you'd normally. The breadth in the market is still very thin, which is very negative. But look, I'm not going to go against this history, and this is why I told you guys over the last few weeks, you can't be short, you can't be bearish because everybody is bearish, and the market was going higher, and it did go higher. Okay, so that situation may continue for a little bit, but it's happened. And certainly, why did it happen? Okay, we had two events last week. We had the CPI, we had the Fed. The CPI was not positive news at all. I don't care what anyone tells you. It was not positive. It showed that inflation is sticky, confirmed that inflation is sticky. And then the Fed did what the Fed did, right? They didn't raise, but the comments were hawkish. The Fed has been pressured into not making this rate increase. Okay, as I said, it doesn't really matter what they do, whether they raise 25. It's irrelevant. But the Fed did something I thought it was impressive. They remained hawkish, and they remain hawkish because they read the data, and I've showed you guys the data. I'm not going to hash this right now, but I've shown you inflation is sticky. I continue to tell you that. And what's interesting about this is the Fed does see higher inflation. Okay, look here. You look at Fed participants. These are people that are voting. They see higher inflation, so they're seeing what. If you look at the data that I see, and I've been showing you guys that obviously Wall Street and the White House doesn't want to see, but they're seeing this, and they do not want to cut rates and have to raise. That would be terrible. So what they've done is they've just put it on hold for a while. They indicate they're going to raise a couple more times. I don't know if that's the case, but they can see, as you can see here, that inflation is not coming down. Now let's look at the Fed statement because this is very interesting as well. You have here a statement where the most important part of this Fed statement is they keep mentioning 2%. The Fed's target, 2%. I mean, it's a pipe dream, folks. It's absolute pipe dream. History does tell us that you are not going to get 2% anytime soon. Okay. And I think I've showed charts before about this. We peaked out. It's going to be 5 to 7 years before we get down to close to levels where, let's say, we used to be. We're not going to ever go below that. I think the experiment of zero interest rates was a disaster. We're never going back there again, thank goodness. But it's going to be a long time. We're going to have rates are going to be higher for longer. But the interesting part is here. This morning, as you can see here, the Fed admitted that there's been pressure, okay? Pressure from the Wall Street, pressure from the White House, pressure from politicians to most likely cut rates, okay? As I told you guys this from day one, this scam of the banking crisis, okay? This scam, all these other scams that are going on that are in the press, that feed into the press, are all a joke because there was no banking crisis. Okay. And as the Fed saying here, you can see here, this was a pressure put on them. That's not their job to adjust policy because of bad management on banks. And the Fed admitted it, that they have been pressured. Okay. So I tried to give you these things, but again, they admitted it, and I knew it was a joke. It was no banking crisis. So again, now you're seeing people piling into these. You could have made a lot of money in these mid-level banks, because now you got people piling into them. I would not pile into them now, but that's where it is. All right, let's go into where we stand. Here, let's go through positioning one by one, and let's take a look at first. We're going to look at here. We are in overbought conditions. Okay, we are definitely in overbought conditions. This, as you can see here, we're extreme overbought conditions. So that tells me that the market, after this last move, probably after today, we have triple witching today, by the way, is probably going nowhere after this. So just be careful because the market is very, very overbought here. Second thing is here, we have something here, CNN. I'm not a big fan of CNN, but they have this greed and fear index. We are in extreme greed levels. Okay, extreme greed levels. As you can see at the bottom of October here, we were at the opposite, and now we're basically above sort of very extreme levels. So again, showing that positioning now has completely switched around. Again, here, look, big inflows. You've had massive inflows into U.S. equities. Again, confirming that there's been a reversal of this bearish trend. People were underinvested. Now they piled into the market the last week or so. Okay, and this is extreme because it's only been a very short period of time that we've seen these inflows. And now we've got investment managers. All right. I mean, this is supposed to be smart money, folks, but I'm sorry. They went. Now they're bullish. Okay, they're coming off, but the investment managers are bullish. That's a reversal sign as far as I'm concerned. And then we have individual investors. All of a sudden have massively changed from extremely bearish to extremely bullish. It's 19-month highs, you can see from this Bank of America. So we've got a lot of people bullish here. And then to confirm that, finally, demand for call options have surged. We saw the put call ratio for many months being puts. Now we've got massive demand for calls. So folks, to finalize this whole positioning situation, people have gone from extremely bearish 2 weeks ago, really bearish, to extremely bullish in the short term. That tells me we're at close to this inflection point. Okay, today is going to be a crazy day because of triple witching, so I wouldn't go short here. I probably wouldn't go short next week, but if I had a lot on the table, if I was a trader and I had rode this market up, I'd probably be taking profits right now. So, but what do we do? Okay, do we get out of the market? Do we pile into the market? Do we listen to this whole bullish call? I wouldn't pile into the U.S. right now because I just don't think that it's extremely expensive. Number one, there's only 7 or 8 stocks really driving everything. So you have to be very careful. But there are places around the world and places in the U.S. where you should buy. First, let's look at U.S. small caps, okay? When we look at U.S. small caps, something I've pointed out in the past, because of this incredible thin breath, they've been completely left behind, okay? And from a valuation standpoint, they have not been cheaper. Okay, going back, over 20 years. So again, a relative trade, buy a small cap index, short the NASDAQ 100, or buy your best or your favorite small cap companies. Look for some small cap companies and, go short tech, because that's the trade. Now, again, I talked about these kind of trades, very difficult to hold for most people. They don't have the risk tolerance. But if you have the risk tolerance, that's the trade you're going to make a lot of money. Finally, here, overseas, I think I've talked about Europe before. I mean, right now, this goes back 40 years or longer. Europe's never been cheaper relative to the US, ever. Going back, forget about it. Forget about 100 years. Ever. This is the most extreme we've ever seen it. Okay, so ex-Germany, and Germany's got a lot of problems. So ex-Germany, Europe is the place where you're going to make a lot of money relative to the US over time. Okay, folks, over time, because you don't ever get these type of extreme. This is 2, 3, 4 standard deviations. Okay, this is one of these sigma events you don't see anymore. So this is where you need to, so whether it's an ETF or buy some big cap European companies, this is where you're going to make your money over the next few years. Okay, so again, to follow up, if you're a trader, hopefully you've been trading this market higher, because as I mentioned, the bearish sentiment was too much, so stay long. Now it's reversed, so I would be taking profits. Again, if you're an investor, I'd stay away from this market. Buy small caps, buy European, buy Japan, which I've told you in the past. A lot of money still going into Japan. And always, always be careful out there.